If one observes with surgical precision the repeating patterns etched into the bedrock of financial history, a singular, devastating error emerges. It is a mistake that has not merely cost investors their profits, but has systematically liquidated trillions of dollars in American wealth over the decades. This error is as common as it is catastrophic. The choice to bet against the Federal Reserve. As we navigate the waters of 2026, we find ourselves approaching a critical tipping point, a rare alignment of economic forces that the world has not witnessed in generations. Those who fail to grasp this dynamic, who choose to fight the Fed rather than harmonize with its intentions, risk watching a lifetime of labor and savings evaporate into the ether of a shifting financial paradigm. This is not a mere speculative prediction. It is a logical consequence of how the global machine functions. When you understand the incentives that drive the most powerful institutions on the planet, you realize that certain outcomes are not just likely, they are inevitable. The architect of the playing field. To understand why betting against the Fed is so lethal, one must first discard the illusion that the Fed is just another participant in the market. In the grand theater of global finance, the Fed is not a player. It is the architect of the playing field. While a professional investor might be the best chess player in the room, the Fed is the entity that has the power to move the squares, change the gravity of the board, and redefine the rules of the game mid-match. The American Federal Reserve stands as the guardian of the world's reserve currency. This status grants it a magical power to make or break fortunes. When the Fed acts, it is not merely influencing domestic interest rates. It is redefining the conditions under which the entire planet conducts business. It is the global thermostat. You may complain about the heat, you may even open a window, but ultimately, the entity that controls the thermostat controls the environment. In the short term, you do not bet against the dominant empire. You adapt to it. Lessons from the giants. Volcker and the 1979 reckoning. History serves as our most brutal and effective teacher. Consider the year 1979, a moment of existential crisis for the American economy. Paul Volcker assumed the chairmanship with a mandate to break the spine of a galloping inflation that was tormenting the nation. To achieve this, he did the unthinkable. He drove interest rates to over 20%. Thousands of intelligent investors bet against Volcker. They believed he would lack the political stomach to maintain such a draconian policy as unemployment rose and the economy groaned. They were wrong. Those who bought long-term bonds, betting that rates would soon collapse, saw their portfolios melt away. Highly leveraged corporations crumbled into bankruptcy, and real estate speculators were wiped out. These people weren't stupid. They were simply arrogant. They underestimated the raw determination of a central bank committed to an objective. They fought the current, and the current drowned them. The era of quantitative easing and 2008, fast forward to 2008, when Ben Bernanke initiated the experiment known as quantitative easing. The experts screamed from the rooftops that this was madness. They predicted immediate hyperinflation and the total collapse of the dollar. They positioned their wealth in massive gold hoards and shorted American bonds. While they may have been right about the long-term theoretical risks, they were catastrophically wrong about the timing and the Fed's ability to control the short-term consequences. By fighting the liquidity tide, these investors missed a decade-long bull market, the greatest wealth creation event in history. They learned a bitter lesson. The Fed can maintain artificial conditions far longer than an individual can remain solvent. The transition of 2026, the pattern repeated in 2020 when Jerome Powell injected more liquidity in months than had been created in previous decades. Once again, the skeptics were crushed. Now, in 2026, we are at a new transition point. The rules are changing again as the consequences of the last 15 years begin to harden. The fundamental truth remains: money flows where it encounters the least resistance. And who offers less resistance than the institution that prints the money itself? To bet against the Fed in 2026 is to bet against the very physics of the financial system. It is a decision to play a game by 1,990 seconds rules in a 2026 reality. Understanding this is the difference between seeing your wealth evaporate or seeing it thrive in harmony with the forces of the architect. To navigate the year 2026, one must first unlearn the traditional definitions of value and price. Most investors view the market as a collection of individual companies, balance sheets, and consumer trends. However, through the lens of institutional power, the market is less like a shopping mall and more like a vast ocean subject to the tides of liquidity. If the Fed is the architect, then liquidity is the gravity of the financial universe. When the architect adjusts the dials of liquidity, he is quite literally altering the laws of physics under which your assets operate. The Einsteinian view of finance. Albert Einstein revolutionized our understanding of the physical world by teaching us that mass curves space-time. In the financial world, a similar principle applies. Liquidity curves markets. When the Federal Reserve increases the supply of dollars, whether through lowering interest rates or direct asset purchases, it is effectively reducing financial gravity. In a low-gravity environment, assets rise. They do not necessarily rise because the underlying companies became more innovative or because the real estate became more functional. They rise because there is a surplus of money chasing a finite supply of investments. When gravity is low, even heavy or low-quality assets can float to incredible heights. This is why we see zombie companies, businesses that don't produce enough profit to cover their interest payments, surviving and even thriving for years. They aren't buoyant because of their own strength. They are buoyant because the Fed has suspended the gravity of debt. The great distortion: price versus value. The most difficult principle for intelligent investors to accept is that price and value have become decoupled. Historically, the price of a stock was a reflection of its future earnings potential. In the era we are entering in 2026, the price is increasingly a reflection of systemic liquidity. Imagine you are standing in a room where the floor is rising. You might look at a chair and say, that chair is getting higher. But the chair isn't moving, the floor is. When the Fed devalues the dollar through expansionary policy, they are raising the floor of the economy. If your house was worth $500,000 in 2020 and is worth $800,000 in 2026, you haven't necessarily gained wealth if the cost of everything else has risen by the same margin. You have simply watched the price adjust to the new lower gravity of the dollar. The mistake many experienced investors make is trying to use value metrics to predict price movements. They see a price to earnings PE ratio that is double the historical average and conclude that a crash is imminent. They are right about the fundamental value, but they are wrong about the physics. If the Fed maintains low gravity, that expensive asset can remain expensive for a decade. As John Maynard Keynes famously noted, the market can remain irrational longer than you can remain solvent. In the modern context, we must update this. The Fed can maintain artificial conditions longer than you can maintain your short positions. The global thermostat and the reserve currency. The Fed's power is magnified by the unique position of the United States dollar as the global reserve currency. This creates an asymmetry of power that is often underestimated. When the Fed adjusts the thermostat by changing interest rates, it creates a ripple effect that forces every other central bank in the world to react. If the Fed lowers rates, it floods the world with cheap dollars. These dollars seek higher returns in emerging markets, commodities, and global tech. When the Fed eventually increases gravity by raising rates or shrinking its balance sheet, that money rushes back to the safety of the US's financial system, often leaving other nations in a state of crisis. In 2026, this dynamic is more volatile than ever. The world is addicted to the Fed's liquidity. Trying to withdraw that liquidity is like trying to take a drug addict off a substance. Cold turkey, the withdrawal symptoms can be more dangerous than the addiction itself. The asymmetry of resources. Why do intelligent people with decades of experience still fight the Fed? Because they underestimate the asymmetry of resources and time. The individual investor has limited capital, a finite lifespan, and immediate liquidity needs mortgages, tuition, retirement. The Federal Reserve has a virtually unlimited balance sheet, a time horizon that spans decades, and the power to create the very currency the investor is trying to accumulate. You cannot win a war of attrition against an opponent who owns the printing press. In 2026, as we face the consequences of the most aggressive monetary experiments in history, the current of liquidity will be the single most important factor in your net worth. Whether you are a conservative saver or an aggressive trader, your success depends on your ability to recognize which way the Fed is tilting the board. Money, like water, flows where it encounters the least resistance. In 2026, the path of least resistance is dictated by the architect. As we enter 2026, the Federal Reserve finds itself at a crossroads unlike any it has faced in its century-long existence. If the previous decade was defined by experimental monetary policy, 2026 is the year the results of those experiments are finally tallied. This is the tipping point, a moment where the Fed's ability to manipulate the environment meets the hard reality of accumulated debt and social pressure. To understand why fighting the Fed in 2026 is more dangerous than ever, we must look at the three converging pressures that are forcing the architect's hand. 1. The debt sustainability trap. The most visible pressure in 2026 is the sheer weight of the American national debt. For years, economists warned that high debt levels didn't matter as long as interest rates remained near zero. However, as we have seen, the gravity of interest rates cannot be suspended forever. In 2026, the cost of servicing this debt has become one of the largest line items in the federal budget, rivaling social programs and national defense. If the Fed were to allow interest rates to rise to natural market levels, the interest payments alone could trigger a fiscal crisis. Therefore, the Fed's incentive is not merely to manage the economy, it is to ensure the government remains solvent. This creates a debt trap. The Fed is effectively forced to keep liquidity high and rates suppressed, regardless of the long-term inflationary consequences. For the investor, this means the least resistance path remains toward more stimulus, even if it feels unsustainable. 2. The rise of the stagflation light scenario. By 2026, the global economy has entered a phase that some analysts call stagflation light. Growth is tepid, hovering around 2%, while inflation remains stubbornly sticky above the 2% target, driven by the delayed pass-through of 2025 tariffs and shifting demographics. The Fed is caught in a dual mandate contradiction. If they raise rates to kill the remaining inflation, they risk a deep recession and a surge in unemployment during a critical midterm election cycle. If they cut rates to stimulate growth, they risk letting inflation spiral out of control. Most investors predict a logical middle ground, but the Fed rarely plays for the middle, it plays for systemic survival. In 2026, the Fed is likely to tolerate higher for longer inflation rather than risk a systemic collapse of the labor market or the banking system. Those who bet on a return to the 2% inflation world of the 2010 seconds will find themselves on the wrong side of the trade as the Fed quietly redefines its inflation targets to maintain stability. Sen, the geopolitical and reserve currency crisis. Externally, the dollar's role as the global reserve currency is facing its most significant test in 2026. After a period of extreme volatility, the de-dollarization narrative has shifted from theory to practice. Central banks around the world, from the BRICS nations to traditional allies, are increasingly diversifying into gold, Swiss francs, and digital settlement systems. The Fed must perform a delicate dance. It needs a dollar strong enough to maintain global trust, but weak enough to support American exports and debt servicing. In 2026, the dollar is expected to pursue a path of managed appreciation. Investors who bet on a collapse of the dollar often lose because they underestimate the Fed's tools to prevent a chaotic fall. Conversely, those who bet on a super strong dollar ignore the Fed's desperate need to keep the global system from snapping under the pressure of high rates. In 2026, the Fed wants a Goldilocks dollar not too strong to break the world and not too weak to trigger a panic. Betting against this managed path is betting against the combined might of the Treasury and the central bank. The zombie reckoning. Finally, we must address the zombie companies, firms that survive only on the life support of cheap credit. By 2026, nearly 20% of the Russell 3000 index is comprised of these entities. They are the walking dead of the financial world. The Fed's trap in 2026 is that it cannot kill these zombies without killing the market itself. If the Fed pulls the plug on liquidity, thousands of bankruptcies would ripple through the credit markets, potentially freezing the banking system as it did in 2008. Therefore, the architect is incentivized to keep the life support running. For the individual investor, the 2026 tipping point represents a moment where fundamental analysis says sell, but Fed incentives say hold. This is the ultimate trap for the intelligent investor. You look at the data and see a house of cards, but you forget that the Fed is the one holding the tape that keeps the cards together. In 2026, the tape is still holding. The transition hasn't ended. It is merely becoming more desperate. Those who fight the Fed's desperate need for stability will find their wealth sacrificed on the altar of systemic preservation. The Federal Reserve's decisions are often presented in the cold, clinical language of basis points and neutral rates. But in 2026, these are not just numbers on a Bloomberg terminal. They are the invisible hands reaching into your wallet, your retirement account, and your home equity. The financial gravity we discussed in Part 2 has created a set of generational traps that make traditional financial planning not just obsolete, but dangerous. The retiree's impossible choice, yield versus survival. Imagine a 5-year-old retiree in 2026. Let's call him Robert. Robert spent 40 years playing by the rules. He saved diligently, avoided excessive debt, and reached his retirement with a $800,000 nest egg. Under the old rules, Robert could put his money into safe 5-year Treasury notes or CDs, earn a reliable 5% return, $40,000 a year, and combined with Social Security, live a dignified life. However, in the Fed-designed world of 2026, the architect has kept rates suppressed to manage the national debt. Robert's safe investments now yield only 1.5% to 2.5% in real terms after accounting for the sticky inflation of 2025 to 2026. His $40,000 income has shriveled to $16,000. Meanwhile, the cost of healthcare, electricity, and protein has continued to rise at a rate that government statistics seem to undercount. Robert faces an impossible choice. Accept a lower standard of living, cutting back on travel, heating, and quality food. Take Fed-mandated risk, moving his safe money into high-dividend stocks or junk bonds to find the yield he needs. The Fed has effectively evicted Robert from the safety of the bond market and forced him into the casino of the stock market at an age where he cannot afford a 30% drawdown. If the market corrects in late 2026, Robert doesn't just lose money, he loses his future. This is the retiree trap. The Fed uses your need for safety to fund its need for market liquidity. The homeowner's golden handcuffs. For the middle-aged homeowner, the impact of 2026 is a phenomenon known as the Great Housing Reset. On paper, most Americans feel wealthier than ever. Home prices surged 40% between 2020 and 2022 and have remained elevated through 2025. But this wealth is a mirage. If you sell your expensive house, you must buy another expensive house at a 6.3% mortgage rate, a far cry from the 3% rate you locked in years ago. This has created the golden handcuffs. Homeowners are stuck in houses that no longer fit their needs because moving would mean doubling their monthly payment for a smaller property. Furthermore, many have fallen into the trap of using their home as an ATM. With the wealth effect of rising prices, millions took out home equity lines of credit to fund renovations or lifestyle expenses. In 2026, as the Fed maintains higher for longer rates to combat persistent inflation, the interest on those HELOCs has become a significant drain on monthly cash flow. You are living in $1 million asset but struggling to pay the grocery bill. You are house rich and cash poor, a direct consequence of the Fed's asset inflation strategy. The young professional running a race with moving goalposts. Finally, consider the 30-year-old professional in 2026. This generation is earning more in nominal dollars than their parents ever did, yet they feel falling further behind. The moving squares on the architect's board are most visible here. In 2026, a young couple earning $120,000 finds that a starter home in a safe neighborhood now costs 7 to 10 times their annual income. In the 1,970 seconds, that ratio was 3 to 1. The Fed's policy of inflating asset prices to protect the banking system has effectively priced out the next generation from the primary engine of American wealth creation, home ownership. Young professionals are forced into two risky behaviors: extreme leverage, taking on massive debt just to enter the market; speculative investing. Feeling that saving is useless, they turn to high-risk crypto, options, or tech stocks, hoping for a moonshot to bridge the gap between their wages and the cost of a middle-class life. The Fed's gravity-free environment has taught an entire generation that hard work and saving are for losers, while leverage and speculation are for winners. This psychological shift is perhaps the most dangerous consequence of all. By 2026, the culture of thrift has been replaced by a culture of desperation. The 2026 reckoning. As we move through the year, these personal pressures are reaching a boiling point. The Fed knows that a recession would solve the inflation problem, but they also know a recession would destroy the retirement accounts of the Roberts of the world and trigger a wave of foreclosures for the golden handcuff homeowners. This is why, in 2026, the Fed will likely choose the path of financial repression. They will keep interest rates slightly below the rate of inflation. This steals a little bit of purchasing power from everyone every year to pay down the national debt. It is a hidden tax. It is the erosion of the American dream, 1 percentage point at a time. To survive 2026, you must stop thinking like a saver and start thinking like a strategist who understands that the old rules of 60/40 portfolios and buy and hold are being sacrificed to keep the system afloat. As we navigate the complexities of 2026, the classic investment playbook, the one that served our parents for 40 years, has been rendered obsolete. In a world where the Federal Reserve is intentionally suppressing interest rates to facilitate the liquidation of government debt, the 60 over 40 portfolio, 60% stocks, 40% bonds, is no longer a safety net. It is a weight pulling you toward negative real returns. Strategic mastery in 2026 requires a shift from financial assets, which the Fed can manipulate, to hard assets and productive cash flows, which have physical and economic limits. E, the death of nominal returns. Focus on the real. In 2026, the most dangerous trap is the nominal illusion. If your portfolio grows by 5%, but the real cost of living rises by 6%, you haven't made money, you've lost 1% of your life's work. To survive financial repression, you must stop looking at the absolute number and start calculating real yield. The Fed's objective in 2026 is to keep the nominal rate, what you see on your bank statement, below the inflation rate, what you feel at the store. This gap is the repression tax. To counteract this, your portfolio must be anchored in assets that possess inherent pricing power. 2. The three pillars of the 2026 portfolio. To thrive in this environment, you must diversify not by asset class, but by economic regime. You need components that work in three distinct scenarios. A, persistent inflation hedges, real assets. In 2026, paper money is being devalued by design. You must hold assets that cannot be printed. Prime real estate, not just any property, but assets in secular winning sectors, industrial hubs, data centers, and community-centric housing. These assets allow you to raise rents as inflation climbs, preserving your purchasing power. Essential commodities, energy, and food producers. Regardless of Fed policy, people need to eat and heat their homes. Companies with fortress balance sheets in these sectors act as a physical hedge against monetary expansion. Gold and hard money. Gold remains the ultimate insurance policy. It doesn't pay a dividend, but in 2026, its role is to serve as a neutral store of value when confidence in the architect's Goldilocks dollar wavers. B, the growth of escape velocity strategic innovation. While the Fed manages the old economy, a new economy is reaching escape velocity. Agentic and physical AI. In 2026, productivity gains are no longer theoretical. Companies that successfully implement autonomous robotics and AI knowledge work are seeing margin expansions that defy the general economic slowdown. This is where you find alpha returns that exceed the rate of inflation. Quality over quantity. In a world of zombie companies, you must seek out businesses with fortress balance sheets, those with low debt and the ability to self-fund their growth. In 2026, cash flow is the only truth that cannot be falsified by monetary policy. C, the agile fixed income. If you must hold bonds, you must be a duration strategist. Long-term government bonds are currently a return-free risk. In 2026, favor TIPS, Treasury inflation protected securities. These are the only government bonds that explicitly adjust your principal for inflation. Emerging market hard currency debt. As the US dollar manages its depreciation, high quality debt in emerging markets often offers better real yields than developed markets caught in the debt trap. 3. Liquidity as an offensive weapon. The mistake most investors make in 2026 is being fully invested at all times. In a distorted market, volatility is not just a risk, it is a delivery mechanism for opportunity. By maintaining 12 to 24 months of expenses in highly liquid, short-term accounts, you gain the psychological and financial freedom to act when the consequences eventually hit. When a liquidity event occurs, which historically happens every time the Fed tries to tighten the board, those without cash are forced to sell their best assets at a discount. Those with cash become the new owners. In 2026, liquidity isn't just safety. It is the dry powder you need to capitalize on the architect's inevitable miscalculations. 4. Reading the architect's true intentions. Finally, mastery requires you to ignore the Fed's speeches and watch their balance sheet. In 2026, the Fed may talk about restraint while quietly launching temporary reserve management purchases to keep the banking system from seizing up. If the balance sheet is expanding, the gravity is being lowered, be aggressive. If the balance sheet is shrinking, the gravity is increasing, be defensive. The key to 2026 is harmonization. Do not fight the current, but do not trust the dam. Build a financial structure that benefits from the Fed's need to inflate while maintaining a lifeboat of hard assets for the moment the dam inevitably reaches its limit. Money flows where it encounters the least resistance. Your job is to ensure your wealth is positioned at the mouth of that flow. As we conclude our journey through the landscape of 2026, it is essential to step back from the immediate charts and tickers to understand the broader cycle we are inhabiting. Ray Dalio, in his analysis of the big cycle, reminds us that while the Federal Reserve is incredibly powerful, it is not immortal. Systems, like empires, move through phases of expansion, overextension, and eventual restructuring. The year 2026 is not just another point on a timeline. It is the threshold of the end of exception. The law of compensation, physics strikes back. For over 15 years, the financial world has operated under a set of exceptional rules. We believe that debt could grow indefinitely if interest rates were low enough. We believe that printing money could solve structural productivity problems. We believe that the Fed could permanently suspend the business cycle. But the most fundamental principle of all is the law of compensation. Every action creates an equal and opposite reaction. The Fed has spent years borrowing prosperity from the future to stabilize the present. By 2026, the future has arrived, and it has come to collect. The Great Reset is the process by which the market finally forces a return to reality. This is the moment when the architect can no longer hold back the pressure of the dam. It is not necessarily a single crash, but a multi-year period where real value reasserts itself over artificial price. In this phase, the exceptional becomes extinct and the fundamentals become fortunes. The 3 hallmarks of the post-2026 era. To survive what comes after the 2026 tipping point, you must recognize the 3 permanent shifts in the global order. The return of scarcity. After decades of abundance fueled by cheap credit and globalized labor, we are entering a world defined by the scarcity of energy, raw materials, and skilled labor. In this world, the Fed's liquidity cannot fix a supply shortage. Assets that represent physical utility will outperform those that represent financial engineering. The fragmentation of the monetary order, the Goldilocks dollar of 2026 is a transition phase. Beyond this, we are moving toward a multipolar monetary system. Your wealth must be geographically and technologically agnostic. You are no longer an American investor. You are a global guardian of capital. The premium on truth. In an era of manipulated rates and managed data, the market will begin to pay a massive premium for transparency and truth. Companies that have honest accounting, real cash flows, and no zombie debt will be the new blue chips. Your final objective, adaptation over resistance. The greatest transfers of wealth in human history do not happen during periods of stability. They happen during restructurings. In 2026, as the Fed's experimental era reaches its logical limit, the majority of investors will be caught in the resistance. They will cling to the old rules, wait for the old normal to return, and fight the new reality until their capital is gone. Your objective is simple: adaptation. Recognize that the Fed is a force of nature in the short term, but a servant of economic laws in the long term. Position your wealth not to beat the system, but to outlast its distortions. Build your life on the bedrock of productivity and hard assets, using the Fed's liquidity as a wind in your sails, not the foundation of your ship. Closing. The opportunity in the transition. The Great Reset that follows 2026 is not a reason for fear. It is the ultimate opportunity for those who have eyes to see. When the smoke clears and the artificial distortions are washed away, the fundamental laws of economics, supply, demand, and value, will still be standing. The Fed can print money, but it cannot print a soul, a skill, or a sanctuary. As we move into the uncertainties of the next decade, remember that the true winners are not those who guessed the right number on a screen, but those who understood the principles behind the power. The architect's time is limited, the principle's time is eternal. Prepare now, harmonize with the forces of today, and you will be the one standing strong when the era of exception finally yields to the era of reality.